everybody. Good to see you all. Thanks for joining. So today we're joined by Ryan Symonds from FRP Advisory. Ryan's got a decade of experience working in corporate finance. I'll let him introduce himself. But what we'll do, Ryan will run through his presentation, and then if you have any questions during, feel free to put a note in the chat box. And what we'll do after his presentation, I'll come to you so you can ask the question directly to Ryan at that point. So just put a note in the chat box and we'll run through them at the end. So yeah, I mean, I guess over to you, Ryan, if you're ready to go.
Perfect. No, thank you very much, Ben. I'll use this as a bit more of a guide, but I believe afterwards Ben will share around, etc. So you guys can have it as reference, etc. as we go through. But I'll start with a brief introduction to myself. So Ryan Symonds, corporate finance partner based in the east of England for FRP. I've been doing corporate finance for the last 10 plus years. Previous to that was in a regional accountancy firm doing the more traditional audit and business advisory. And then prior to FRP, I was at a corporate finance boutique called JDC Corporate Finance, which we sold into FRP in 2020. And from there, we continued doing my specialising in various corporate finance transactions, whether that be trade disposals, acquisitions, private equity investments, and all other, I guess, related transactions in that. From a personal perspective, I'm sector agnostic, but I guess specialise in working with owner managers and management teams in that respect. So that's myself in a nutshell, with a selection of some private equity deals that I've been a part of on the right-hand side, with a few more in the background as well. So just a quick overview of FRP. So FRP is a specialist advisory firm. Got 5 pillars, maybe aware to some of you, maybe new to others. So we specialise in corporate finance, debt advisory, restructuring, financial advisory, forensic services, so covering off from a restructuring perspective, stressed and distressed businesses, corporate finance, buying, selling, raising equity, debt advisory, raising debt for both corporates and private equity, financial advisory will incorporate due diligence, bank reviews, valuations, pension advisory, and then forensics will be relating to investigative independent reports, valuations for shareholder disputes, matrimonial, court appearances, etc. like that. Keep that into its high level, but then I guess my area of focus being corporate finance. So within FRP Corporate Finance, just a quick overview on that. So we've got a team of circa 100, 120. Of that, there's 25 partners that are based nationwide. Last year, in the calendar year to December 24, we closed 101 deals, 1.8 billion in value. Alongside that, raised 750 million of debt. And I think probably one of the key metrics on that was that through our transactions, 51% of them involved PE, whether that was selling to PE as a platform investment or selling a business as a bolt-on to them. And I think probably, the last couple of years within the mergers and acquisitions market has been, I guess, lower volumes. And that's, due to capital costs, interest rates, general economic volatility, a range of what international issues relating to that. So that's probably there. But I think probably a key element of that is, despite those tricky periods, their private equity have been particularly active in that space and continue to be the backbone to a lot of the transactions carrying on. And we continue to see that going forward and on numerous transactions that we have both on regionally and nationally from a business perspective. So I'll just do a brief introduction to PE. Obviously, I'll understand there's probably a wide range of understanding here, so I won't. We'll try and keep it high level, but go into enough bit detail for you. But private equity, I guess, covers the full spectrum. It will cover from early stage seed investment fast growth businesses, established, your lower mid-market, which, profitability from your million to 50 to 100 million EBITDA, through to, the large cap, multi-billion pound investments that will hit the headlines. I guess from FRP and our focus have been very much in that lower mid-market, where we have established relationships, full understanding of the investment criteria of the funds, whether that is through size of business, sector focus, dynamics of transactions, locations, growth strategies, etc. And I guess the underlying premise that probably sits within all PE as an entirety, they're looking for strong management teams, growth prospects, either organic evolution of existing business plans or more targeted buy and build strategies on there. They will tend to focus on more cash generative businesses with strong market positioning to effectively build upon. And then if you're looking at your overall deal perspectives, they will tend to look to make an investment, look to hold that within 3 to 7 years typically. Some funds will be evergreen, which will have a bit more flexibility, but the 3 to 7 is more of your traditional range for your standard mid-market transactions, with somewhere traditionally aiming for somewhere between your 5-year realization point. And then alongside that, obviously, they are financially driven, so we'll be looking to make 2.5 to 3 times their money return going through that. And that can vary. They'll have some obviously investments that won't do quite as well, and then they'll have ones that will proceed a lot quicker, etc., and make greater margins for them. And then on the right hand side, we've kind of just got a private equity like value creation example of where shareholder value sits, reinvestments, and then how that evolves over that period. I won't go through that in detail, but as I mentioned before, Ben will share this, so that can be hopefully can give you a bit of context on how they structure and move things forward in that. But ultimately, there is a great deal of flexibility within private equity transactions, and each transaction structure will be required to be modelled on its own case, and there'll be large amounts of variations within that there. So I guess probably one of the key things which you're always looking at, given the the wide range of private equity funds and what they are able to utilise their funds in and around the UK, which we focus on at FRP, I guess there's probably 3 main reasons utilising private equity funds, which can be through your management buyouts, succession planning, de-risking for founders. In that respect, you can utilise it for development capital, which is inward investment into the business, to either fund the existing business plan or accelerate the existing organic business plan. Those areas can cover things like international growth, entering new markets, product development, working capital investment to support the business. Then there is probably more inorganic growth, which would be then your buy and build strategy, which would look to, whether that is increase your market share, expand internationally through an existing platform, acquire new products, technology, advancements of the curve up there. And those are the 3, let's call it, overall reasons that tend to be. But typically, we would see that you'd probably combine 1, 2, or even sometimes all 3 of those options within transactions. Typically, even if it was a development capital deal or a buy and build strategy deal, where the money would come in, we tend to see that there would be an element of de-risking, or it could be that the management team wish to, accelerate the growth through either organic or inorganic, and therefore there will be some sort of, cash out element alongside those as well. So that is very much the piece there. And I think probably one of the key takeaways is that there's a great deal of flexibility within the private equity structures, and that, you know, give or take, all variables can be, you know, taken into account. May not be able to achieve everyone's ambition, but you're about to cover off, you know, a large amount of what is the possible bits of moving forward within a transaction. So dropping on to your PE characteristics here. So ultimately, private equity are motivated financially, but will look to align themselves with founders on their rolled investments or management teams. So, you know, from a returns perspective, to align everyone's interests. We're obviously seeing a strong presence, what I mentioned earlier, within the PE market, both from a value perspective and structures. But I guess the key piece would be is that there are, you know, a wide range of private equity houses out there, which will look to be either sector focused, sector agnostic, etc. So there'll be a few different elements to just take into consideration there, and there'll be you know, a wide range of those. But ultimately, if you're looking at that and some of the added value that PE then bring to the party is, you know, through their investment cycle, they'll look to, you know, bring on chairman within there, add further capital resource to the business, you know, can lead to professionalization of board reporting, etc. However, alongside that, there are obviously the other side of it being, you know, some considerations. So when you're going through, due diligence tends to be a greater level compared to trade processes. I guess business plan, financial models will be put under, I guess, greater level of scrutiny. Obviously, level of due diligence, as I mentioned, and, you know, there will be, you know, a reasonable amount of professional fees through this, because from both a buyer's perspective and being the shareholders, sellers, management teams for their advice on those as well. And then I guess linking through to that, your legal side and piece, there's obviously greater levels, because you've got not only the sell side for your SPA and ancillary documents there, but you've also then got detailed investment agreements going forward that will cover off, you know, good leaver, bad leaver, the shareholder structures, etc., alongside consent matters on, you know, as what needs to be pre-approved for transactions and elements to that. And I guess the key other piece is that typically on transactions, private equity will have control of the business, whether that is through shareholder board control or alongside that being, you know, negative controls of what you need consent matters to carry out. However, alongside that, majority of private equity will be relying on the management team to retain the day-to-day control and ultimately effectively continue the running of the business on that basis. What they aren't looking to do is to come in and take it over the business, and they will rely on that. That tends to be your lower mid-market. That obviously can be some funds that will have different views on that, but there are different elements to there on that to take into consideration. And I guess probably if you then look at, you know, what do PE look for? So ultimately, they're looking to generate equity value for all the stakeholders. Look to align basically their fund with management, with founders, depending on their position in the business. But ultimately, where they want is a defendable business model with good growth prospects, whether they're, and through that, you know, with their market positioning, is that innovative products, services, which kind of links into your defendable position. Obviously, as I've mentioned, management team are very key. Doesn't always mean the management team needs to be full and complete on completion. So it could be that actually one of the things to do post-deal would be to make certain recruits, whether that is increasing, sales functions, operations, or something like that, finance function, etc. And then obviously where they will be looking at through that is, you've proven strong margins, cash generation with the business, but ultimately then what they'll be looking to do is their typical holds, as I mentioned before, that 3 to 7 years, average 5. Where they'll be looking at is obviously at the point of their investing, they'll already have an eye on where their exit routes will be, whether that is off to trade parties, whether that's secondary private equity, IPO, etc. So they'll already be planning on that as they go through that process. And so that when positioning the business and taking that out to market, it's good to have for both management teams and founders to kind of have that in the back of their mind to go through and have that understanding. Then, so that's kind of what PE you're looking for. And I guess a key area to this is then the next piece, which we'll flip on to, is then actually, what about planning for investment and preparation for that? Going through the transaction itself will take a large amount of management team, shareholders' time. So the more planning will be very important. It will help, value, structure, increase the likelihood of a transaction completing, going through that. So some of the areas that we try and at FRP work with. So whilst, help a business through their journey alongside and help them prepare with the view of, a lot of people will look to, appoint advisors in advance, assist with this preparation, and then so that when the time to go to market, then a lot more will be a lot more prepared. But I guess a few key areas will be obviously historic record keeping. Due diligence process is onerous. They'll be utilising professional firms from for financial, tax, legal, commercial, even into management DD, insurance, technology, if IP, etc., depending on the type of business. So having that good base of and sound like record keeping, whether that's from your statutory books, whether that's your historic financials from management accounts, supporting schedules, and all that. The other piece is that when you're going through, obviously that's your historic records, but then the ability to, let's call it, develop your management information, your management accounts in a timely manner is always helpful, because as we're going through the process, takes anywhere between 6 to 12 months for a private equity transaction to take place, depending on preparation, depending on a number of different factors. But having that as you're going through the due diligence process and going out to market, speaking to parties, then following up with the due diligence once in exclusivity, etc. They will continue to want to monitor how existing trading is going in the business. So by having that, develop that ability to create management information in a timely manner, but also incorporate the key financials and operational KPIs, whether that is project gross profit margins, whether it is turnover, utilization of staff, downtime, all of those different factors. But it's important to try and monitor those, because then a lot of that they will be due diligence the historics and then referencing how that then falls into, let's call it, the future forecasts, and we'll use that as a basis. Naturally, not always the historics will mirror what is the forecasts, but there'll obviously, hopefully be the rationale between what those differences are. But then I guess from having your historic information, your timely management information, it's then obviously developing a business plan as well. How the businesses continue to grow, outline those growth areas, what it needs, is it investment in, is it strategy, etc. But to articulate that, and And that can be, around having market trends to support that, or, or certain growth aspirations, etc., to how to build that together. That's very much how to articulate your growth plan. But then alongside that, that's where the financial model integrates in with your growth plan. So, a good financial model will, effectively be given the numerical story of the business plan. But then within that within the financial model, it's important to have, good, strong set of assumptions that will hopefully be underpinned, or if not underpinned, but rationale why that differs to historic trends. Also, if it can be set up, so it can be like stress tested, so it can have, various assumptions put in, both positively and negatively, and so that helps. And by having that good financial model, which they will tend to look at for a 3-year look forward forecast on that as well, and that then enables them to, from an investor perspective, when they're reviewing the opportunity to invest into X business, that then will help them, give them the ability to, review, reflect, and model what potential returns could look like for them. Because as I mentioned earlier on, they are financially driven. They will be looking to make, 2.5, 3 times their money on average across their investments. So those elements, which always helps them to say, obviously, is there enough growth in this business to enable them to go up that curve, and it drives both value, structure, and everything around that side of things. Alongside, creating your business plan, and obviously your management information, etc. Hopefully that will then enable you to then, identify the risks in the business, and they can be a whole raft of things, whether that is reliability on employees, commercial rationales, being customer concentrations, sector concentrations, financial, legal, all those different areas. So by identifying them at an earlier stage, you can then, look, not all risks can be mitigated, that's impossible, but where possible, it can be, if that is, a risk sitting with the managing director because he is the operations director, sales director, everything all involved around him, is that to then, say, let's build out the management team around him, try and de-risk it from him. So if the proverbial bus did come and get him, then the business continues to run without him. Those sort of things to take into account, which then actually links on to my next point, which is the established management team. So whilst the business, the fundamentals of the business is going to be important, but alongside that, private equity will be investing in the people as well as the business. So that is, having financial CFO, FD, having the right management team. They don't all need to be shareholder level or board level, but it's important to align and show, the key roles of the business and how those will be spread over a wider number of people. Then it's always advisable to, engage advisors early doors, whether that's legal, tax, corporate finance. This then, enables them to work with you on, planning for that. It enables, timing of going to market can be important. And also for them to then manage competitive process, working with you, preparation, all of those areas to give you the best chance of going through the transaction, which will be onerous. And one of the things, people don't forget because it's there, but you also have a business to run on the day-to-day. So, those elements are very important in that respect. And then one final piece is vendor due diligence. I've seen deals done with vendor due diligence and without vendor due diligence. There isn't a right or wrong way. Traditionally, private equity do rely and utilize vendor due diligence going through that. So that can be carrying out your financial due diligence in advance, and then all your commercial due diligence, market reports prior going to market. Through the process, the PE house can then, once at the point of completing a transaction, they can then take that and rely on that. They will typically do some follow-up DD on it as well, but that will be a smaller level of due diligence than the initial, large financial due diligence scope that will be. And the other piece that then, by having the financial due diligence, that then enables you to have more control, or your advisors and management team, shareholders, to have more control over process, time frame, able to maintain that competitive tension deeper into the process. So those are key elements that can be done through that. The downside to vendor due diligence, you're effectively investing in the due diligence process ahead of knowing if there is an offer or if there is an interested equity investor in that. And we've also seen it where people have ran dual track processes with both private equity and trade, that then if it's gone trade, they have still insisted on utilizing their own due diligence providers and weren't willing to utilize the vendor due diligence. But those are, some risks to take into consideration there. So that's the overview there. I guess I'm conscious on time as well, so I'll move on to question and answer. Obviously, from a private equity perspective, there are so many areas, so many variables within structures, processes, etc., that I could talk for hours on it, let alone 15, 20 minutes. So more than happy to, if you wish, reach out afterwards, can have more detailed sessions and cover in any areas that wish to be discussed in more detail.
Awesome. Thank you, Ryan. If anybody has any questions, if you just want to drop a note in the box or raise a hand or whatever we do on these things, and we can try and get those. I'll come to you. You can ask the question if anybody has anything. Can't see anything in the box, but what we'll do, we'll send out a copy of this to everybody afterwards as well with the presentation. And here we go. They're coming through here. So Nigel, you got a question for us there, Nigel Armit.
My question was a quick one. How do you ensure investors share your vision and timeline for an exit?
So a lot of the time, let's call it the vision, the business plan of where the business is going to evolve to, that is covered up front, early doors, and will be a part of the various management presentations alongside that. Because the management team still have a large or will be running traditionally the business on a day-to-day basis. Traditionally, the PE house will be, there'll be an element of reliance on them, and they can be guided by the management team of when the right time is to go to market. Both they will be closest to the sector, seeing other activity, etc. So very much the next party to take this on will have reliance on the management team. So it is important that both are aligned, but a lot of that is set out up front, whilst not set in stone.
Thank you.
AJ, you had a question?
Yeah. Yes. Hi, Ryan. Thank you for the very excellent presentation. Just a quick one, really. So you talked about investment. I guess it's primarily UK, but do you look at opportunities in, say, Asia, if there is something? And what is the minimum size of fundraising one can look at raising for that part of the world?
Yeah, so from my perspective, very much looking work with the UK investors. Some of those will be European or US investors will invest in the UK, but my speciality will be UK headquartered businesses, but a number of those will have overseas subsidiaries, overseas operations, etc. So tends to link the investors that we will be working with primarily will look at UK headquartered businesses, but with an international angle from like operations and subsidiaries, etc.
Great. Thank you for that.
And Matt, Tyler, you had a question.
Thank you. Thanks, Ryan, for the presentation. Are you starting to see any sort of more trends with sort of PE firms looking more into sort of the professional services firms, and that sort of continue into the future?
Yeah. So at the moment, if you said one of the key investment areas that we're seeing is human capital, whether that is legal, accountancy, services, environmental services, that side of things. And actually got 2 transactions, one in the legal space at the moment and one in the environmental services space at this very second. So seeing, a lot of interest from private equity. You'd have seen it's a larger end of the transaction spectrum, but Cinven invested in Grant Thornton, Horizon Capital exited Danes to another PE house. So there is a lot of interest in, advisory professional service firms at the moment. And a key area of that, I think, where they're seeing in that growth is, automation, AI assistance, the ability to, evolve, relatively stable industries.
All right, brilliant. Cheers.
Thanks. And Al, Joey, you had a quick question?
Yeah, a quick question. Would PE look at anything pre-Series A, Series B? Would they look at seed funding?
There are VCT funds that will go down to that level, and then there will be more of like regional like capital funds where they've brought together a group of high net worths, etc., that will co-invest on opportunities. We'll have platforms to enable presentations for owner managed entrepreneurs to pitch their business plans, etc. But from my perspective, I don't do much within that VCT area in that, but there are, and there will be, and there are a large number of those.
All right. Thanks very much, and thanks for the presentation, Ryan.
No problem.
Thanks, Al. Shane, you had a question. Shane Giuliano.
Oh, thank you. Thank you very much for the presentation. Just very quickly, I'm assuming that FRP have access to a large number of PE funds, so that if someone actually approached yourselves, that you'd be able to direct them in the correct manner as to which kind of PE funds they should be looking at approaching for investment.
Yeah, no, definitely. Like across myself and my colleagues, we have very established relationships through the lower and mid-market private equity houses, have a full understanding of what their investment criteria, speak with them regularly. Internally, we manage that so that, everyone is aware of whether that is a sector focus, size, transaction type, etc. So, we have that, so we can easily, there is, I don't know, hundreds of private equity or VCT funds within the UK, but we would, as a part of our processes, we would look to narrow that down to a manageable area to approach and market the business to, and that can vary from a short select number out to a wider market testing.
Wonderful, thank you.
And then the question from Mike Brooks.
Hi, thanks very much, Ryan. Brilliant presentation, really appreciate it, thank you. Just in terms of broad brush, just generally, where's the tipping point between approaching high net worths for investment within a business, an already established business, and then approaching PE, private equity? Where's your minimum? Where do you feel that is?
So I personally feel that, probably the £1 million EBITDA is, there will be some private equity houses that will drop to the £500,000, £750,000. But probably the £1 million EBITDA is the minimum barometer, and then driving up. Have seen more recently a few more of the lower based firms move slightly higher, but then they're getting replaced with new funds coming out that are still looking at that sort of level there. So yeah, £1 million EBITDA traditionally, but there's so many different attributes that link into that, whether that's growth prospects, business plan, all of those different areas. So
Thank you.
And Jan, you've got a question there.
Hi, Ryan. Thank you for the great presentation. I just want to check, is the PE sector open to hiring those with no private equity experience, or what is the route to get into the private equity sector?
So are you talking from a finance director perspective in that respect?
Yes.
Yeah, so yes, they do hire people with no, I guess, private equity experience in that respect. They can look for FDs with sector-specific experience. Or at times, obviously, every private equity FD would at some point would have had no private equity experience. So yeah, so very much through that, it would be looking to liaise with recruiters that, in my view, would be liaise with recruiters that have private equity firms on their databases, and there'll be some private equity that manage their own talent acquisition. So always worth approaching directly to those as well.
Thank you.
And Graham Banks.
Hi, thanks for the presentation. With a buy and build strategy, do you have any insight on how a private equity looks at the possible acquisition targets, and what makes them sort of attractive?
So first of all, you'd probably then go back to the fundamental business plan of what you're looking to achieve from a buy and build strategy. So you would be looking at whether that is something like internationalization, whether it's growing market share, adding products, services to your existing. So all of those different areas to that. And there'll be a number of platform investments that would have never done an never done an acquisition. And that's where the private equity house can really add the value, whether that is a chairman that's gone through the buy and build strategy before, or whether a PE house, have a hands-on approach and support the business on their acquisitions. And naturally, they are looking at a lot of businesses on a regular basis. So we'll have a very good understanding of what is good in the marketplace, and bring the experience to the board to be able to highlight where potential risk factors are in acquisitions, alongside the management team that will most likely have a good understanding of the sector itself.
Thank you.
Nice stuff. And then final question here from Amer.
Thanks, Ran, for a brilliant presentation. Just a quick question. What are the top 2 or 3 metrics that they use for a forecast valuation from an exit perspective, if they're looking at investing in businesses that are looking to raise at Series B, Series C sort of level?
Yeah, so there are many different ways how to look at that. There'll be many fundamentals within the business that will be, is it recurring revenue basis? Is it profitability? Those sort of things. So where you'd be looking at those, you'd be looking at comparable transactions in the space would be the key metrics to be looking at. So similar sector, but on probably a larger scale, tracking what other transactions have been happening in the market, but also taking into account the time and the impact of that. For example, if you look back at 2021, 2022. That was very high levels of M&A transactions, but then also led to increased valuations. If you're looking at where we are today, that has softened from there. So there isn't a science to that. It's probably be a bit more of an art of bringing in, various data points from relatable transactions, listed multiples, and then obviously, where the business is and where they are on their growth journey, etc.
Right. Okay. Thank you for that. Thank you.
Great stuff. Well, I think that's all the questions. So thank you, Ryan, for that, and thank you for everybody attending. We will send a link out to this, so you'll have a record of it, and also links to our members area, so you can log in and view previous events, and our future events will be listed there as well. But thank you very much for everybody for attending, and we'll hopefully see you again soon.